Hey guys, in this video I'm going to be talking a little bit about credit scores and how they work. After you've watched this video, you will understand how credit scores work, how they are calculated, and why they are important in your future. So let's get started on this video. So, the first topic, how credit scores work. In the credit score world, the term credit simply means your reputation as a borrower, and it has to do with your history of staying on top of loans and credit cards. Some of you may be scared by getting a credit card or going in debt simply because of other stories that people in your life have had. But debt is simply a tool used to manipulate money. It's not good or bad, but it can be used in great and terrible ways. Before lenders will sign off on loans with you or open a new credit card for you, they want to find out your personal credit report. The credit report tells them your borrowing history. Based upon their credit report, the lender determines how much to charge you for the loan and whether or not to approve you for the loan or not. So, whether it's taking a loan out to pay for college, a new car, or a new house, credit scores are super important. So before we get on to how they are calculated, you need to know that a score is like a diploma. It's just a number that averages your history. You can look up your credit report, which has all the information on your borrowing on it, just like a grade report. But lenders like banks and businesses don't want to spend 15 minutes analyzing how well you pay back your loans, especially when they might have 300 applicants that day. Instead, credit bureaus use an algorithm, which is occasionally updated to give you a number, a credit report, a credit score. And that number is used by the banks and businesses to assess your credit worthiness. So let's go on to how credit scores are calculated. So what determines your credit score? Credit scores are determined by credit bureaus or credit report agencies. But to get your credit score, you have to start with the credit report. Credit bureaus are simply companies that gather your financial information onto a report called your credit report. In the US, there are three main credit bureaus: Equifax, Experian, and TransUnion. The Fair Credit Reporting Act, issued by the U.S. government, sets standard guidelines for all credit agencies to follow when reporting on your credit. Other businesses, like lenders and banks, can buy your credit report from the credit bureaus. These credit bureaus use computer programs to analyze a credit report and give you a score, just like I explained earlier. This software scans a report for qualities, patterns, and potential pitfalls in your borrowing history. The credit score is usually what most lenders look at. With so many loan applicants, they don't have the time to wade through pages and pages of each person's credit report, so they just come up with a number. Credit scores make it easier and faster to determine your loan eligibility for applicants. So what's on a credit report? If you really want to see what's on your free credit report card, go sign up at creditsesame.com. That's what I use, and they give you a free credit report card. And they also give you a free credit score update every week. If you don't monitor your credit report or score very often, someone could be stealing your identity without you knowing it. Credit reports gather information about specific credit history events, so to speak. They list things about the amounts that you've borrowed, your payment history, whether or not you have any outstanding loans, any loans that you've had in the past 7 years, current loans, any minimum monthly payments that you're making, and instances of foreclosure or bankruptcy. So, how can we reverse engineer this? What factors make up your credit score? Each credit bureau puts out a credit score, or a FICO score. FICO credit scores range from 300 to 850. Now, the score is made up of the following factors. 10% of it is the type of credit. So is that an auto loan, a home loan, a credit card, a student loan? This makes a difference, but not very much. On to the next 10%. So new credit is basically your credit-seeking activity. Statistically, if you are seeking lots and lots of new credit in a short amount of time, you are seen as risky, which makes your score go down and your interest payment go up. Credit bureaus check these by something called hard inquiries, which is a term anytime a lender checks your score. The next 15% of the credit score is calculated by the length of credit. So this would be your oldest account, your newest account, and the average age. The largest portion of your credit score is determined by your payment history. Now this can be good or bad, but it also deletes off after 7 years. And if you have a bad payment history with a couple of bad notes, you can actually call some of the lenders and get some of these bad payment histories removed. The last 30% is the amount owed. So this is called credit utilization, which is the percentage of how much you've actually borrowed divided by how much you can borrow total. On a credit card where you might have a limit of $1,000, if you only use $200 of it, your credit utilization will be 20%. Experts say to keep it under 30% to stay in the clear and under 10% for best results. So what do credit scores mean? Here's where the good credit versus bad credit comes in. A high credit score is a sign of a good borrowing history. The lower your score, the harder it is for lenders to approve your loans. They will see you as risky and they won't want to give you money. It's common for lenders to set rules their applicants must fit in order to sign a loan with them. Like one lender might not approve scores under 650. The same lender might approve scores between 650 to 720, but give them a higher interest rate. Then for scores that are over 720, they might get a low interest rate. So here's why credit scores are important in your future. Like we said before, good credit scores are important for securing loans. Securing loans mean that you are better equipped to accomplish your purchasing goals like buying a house or a car, or even paying for college. Because let's face it, if you're not rich, you're going to need some type of loan to help cover such huge necessary expenses. And even if you do have a ton of spare change laying around, it's a good idea to keep some credit active to keep your score high. I'm sure I'll get a ton of comments about opinions on this topic, but that's for another video. I want to make this very clear. If you use a credit card correctly, you will not have to pay any interest, but your credit score will increase. I'll cover that in a later video if you guys want that. Credit is not bad, it is when you use it irresponsibly that it can have downfalls. For some people like me, paying $400 on total interest for a car loan is worth the 100-point increase over 3 years to be able to get a lower interest mortgage. Now I'm going to leave you with two main takeaways from this video. The first one is, how do I get a copy of my credit report and credit score? So you can get a free credit report by going to annualcreditreport.com. Now, credit scores are a bit harder to get. Hard, but not impossible. One easy way to do this is to ask your lender for a score next time you sign up for a loan. Credit Sesame is what I personally use, and there's an app that I downloaded to check it weekly. Number 2 is, what can I do now to make sure I have a healthy credit score? So it's never too late or early to start improving your credit score. There are some easy ways to get and keep a good credit score. 18 is the prime age to start working on your credit score. Here are a few suggestions to get you started. Pay your bills on time. Sounds like a no-brainer, but seriously, this is one of the easiest and most important ways you can have good credit. You can increase the effectiveness of this by having a monthly budget where you track your money. Also, diversify your types of credit. This just means having different types of credit in your borrowing history. Different credit cards, different loans. One easy way to do this is to have a credit card or two, but make sure to pay it down to $0 each month. This will increase your credit score. And, of course, be a wise consumer. If you're like me, it's way easier to spend money than save money, especially if you aren't tracking it or if you're in business. But try to base your spending decision on what you need, not what you want. This will ensure that you don't overspend or impulse buy, which can cause you to be default on your current loans or payments. I hope you guys enjoyed this video, and if you want more like it, subscribe or leave a comment below. Thanks for watching.